Two. Ladies and gentlemen, good morning and welcome on the webinar on these recent changes into Schedule 3 to the Companies Act and CARO 2020. And with us today, we got the chairman of the members in practice, Dr. Sanjeev Singhal Saab. Then we have Chiriniwas Joshi Saab. He is a chairman of the Committee on the Corporate Law and the Governance Committee of ICAI. And we also have Mr. Amit Gupta and also have Sarika to dwell upon this. And all of them will tell you that what are the changes. क्या है वो चेंजेस कब से एप्लीकेबल हो रहे हैं एंड व्हाट आर द रैशनल्स ऑफ दिस चेंजेस ये सब बयां करेंगे हमारी टीम द गैलेक्सी ऑफ द स्पीकर्स वी हैव टुडे एंड आई थिंक इट्स माय वन ऑफ वेरी ऑनरस ड्यूटी टू इंट्रोड्यूस नन अदर देन द chairman CSC Yoshiji ji, and he's the chairman of the corporate law and the corporate governance committee. जोशी जी के बारे में एक बात कहता हूं कि he does not introduce but still ये दिल है कि मानता नहीं. जोशी जी has spent his 40 years in the practice. Post qualification experience is 40 years, 4 decades, 40 साल बहुत लंबी होती है. And the best part is that more than half of this 21 years he has spent in the seva of ICAI, either as a convener of the Mulund or WIC chairman or the central council member, and he has been the independent director on the L&T Mutual Fund, SBI Cards and Payments Limited, director XBR Limited, and the director on Accounting Research Foundation ARF ICAI. I got something common with him. He is a past president of Rotary Club of Mumbai Mulund East for the financial year 12 and 13. And I don't want to take much of time. And here I invite Chiriniwas ji. Chiriniwas ji, welcome ji. Show में आपका स्वागत है sir.
Yagnesh sir, it's a good show and you are a good, we shouldn't call you convener. I hope we call you event manager, the way you speak always in various seminars. But thank you very much for Sanjeev ji, who is my CCM here, and all the other panelists and Yagnesh ji. I think I owe a lot to Sanjeev ji in the council, as is one of the finest council member that we have found. It's a recent find of the council because he's in his first term, and a very, very dedicated, very intelligent, very committed, highly experienced council member, and it's really an asset, I must say. And when he arranges something, CLCGC any of our committee will jump into it if he arranges something. So I must first thank him for giving us this opportunity to arrange something for him. And always, as usual, I expect as a chairman of this committee that as usual, he is participating, his partners are participating. The conference or any conference, any discussion, any panel has to have a high quality deliberations. I have participated in some of them when he was there, and I can vouch for that. Coming to the subject, friends. This MCA notification first is dated 24th March, which amended Schedule 3, is effective from 1/4/21. When we rang up MCA, they said this is applicable for accounting year, ending on March 22, because you are aware that in a limited review, you will not have notes to account, disclosures, etc. So first time disclosures were coming 22. We have asked them to give it in writing, especially because MCA notification on the same day is amended the audit and auditors rule also. And subsequently they had amended on 25th, some of the accounting rules as well. And then they came out saying that on 25th that they are applicable and for, say for example, for software changes, etc. applicable from 1/4/21 accounting year starting. Now there are several issues in several amendments which come from government. For some of them we and CS Institute, we are part of such amendment. They ask us, they take our advice, but some of the amendments go through some other committees or some other groups, maybe some other trade association, etc., and not discussed with ICAI, and therefore a lot of guidance is subsequently needed to the profession. Friends, I'm happy to share that there were 3 groups previously for Division 1, Division 2 and Division 3 in CLCGC, where we have issued guidance note. This time when I found all the amendments that are there, or all the new disclosures that have come, are almost common for all three. So I have formed a new group in CLCGC, but I have drawn those experts from all three groups of the past and requested them to come out with some guidance in all this. And therefore, today's webinar is extremely important to CLCGC and the group as well, as to what are the opinion of various experts here, so that we can incorporate these opinions also in the guidance note that would come from ICAI in due course. I find there are very, very major changes, and I would request some of those who are expert in this to guide us on that, especially on some of them look like really the only the data, for example. But I always feel when data is there, it has to be used in audit. It has to be used by the chartered accountants. For example, a simple thing like change in promoter shareholders. It looks like data, but if it is substantially changed, obviously it has lot of implications in audit. I will request the panelists to give us the implications in audit also. If you say that, how auditor should be cautious if the promoter shareholding drops from 40% to 10%, or they have pledged their shares, even that is there. So if they have pledged, what is the implication and what risk the auditors carry? Because I will like to link these two things there so that the listeners are really aware. There are few new things have come. For example, they are never asked about unbilled revenue. Now we have a separate guidance on early warning signals of fraud. One of them is unbilled revenue increase in disproportionate to the turnover. That is one of the things we have stated there, by RBI also has stated. Now these things, will affect audit substantially when you are only giving presentation of unbilled revenue into years. But when unbilled revenue goes for years, say 5 years, then what is that unbilled revenue? Why you are not billing? And can be a very serious issue there. So there are some such things like, other things are okay. Capital WIP, you have to show the details of Benami Property or willful defaulter. Company has a willful defaulter or a relationship with the struck off companies, as because if the company is struck off, how we are going to recover will be an audit issue. Various ratios and change over 25% over last year. I found that such new things. Now if the ratio changes 25%, for example, liquidity ratios or other ratios, you may have other implication, as Sanjeev Singhal has been saying in other seminar on, say, going concern. Because these ratio changes is a data. How you use that data in other part of audit is something which is great to be seen. Undisclosed income, for example, or details of cryptocurrency, which is not allowed by RBI. Now, some of the things, is this a violation under the, the guidance in audit is that there is a violation of any law. Then you need to state. Now, this is whether it's a violation. If it is, then how you state it. So, just giving a data here, I am just cautioning the listener. Just giving a data is not right. You just see what are the implication on other aspects of your work, your consultancy work, your audit work on the company is important. Also look into the company's audit and auditors rule amendment. CARO, of course, we have already issued a guidance note, CARO 2020, which was postponed 2 years. Now, of course, it will be available from next year. Again, it is not applicable for limited reviews, but whenever it is applicable, there is a very good guidance which has come out from the institute, and this panel also will add to that guidance, I'm very sure. And with this, thank you very much, Sanjuji, for again giving us opportunity to be part of your team, and Yagneshji for introducing us. Now over to Yagneshji for further proceedings. Thank you very much. Thanks a lot.
Thank you, Joshi Saab. Thank you for setting the tone. क्या बेहतरीन अंदाज में आपने नींव की ईंट डाल दी. So now people are now getting excited to hear from the stalwarts, and the stalwart, the first being is और कोई नहीं हमारे डॉक्टर संजीव सिंघल जी, and I am more happy to introduce him because एक मित्र को इंट्रोड्यूस करना इससे अच्छा सौभाग्य क्या हो सकता है. Correct? And he's a good friend of mine. And Dr. Sanjuji, his very recent entry, I believe it is the first year of his tenure as a Central Council member. Am I right, Sanjuji?
His first term.
First term. मगर फिर भी लगता ऐसा है कि आप जैसे सालों से इंस्टीट्यूट से जुड़े हुए, परसों से इंस्टीट्यूट से जुड़े हैं. I mean, to your credit, there are 12 books, 1 dozen book है, 650 seminars you have addressed, and now you are been given सूत्रधार of chairman of the members in practice. Am I right, sir? तो सर अब चूंकि मैं भी प्रैक्टिस में हूं तो हमारी सर एक्सपेक्टेशन बहुत है आपसे सर एंड वी आर श्योर दैट you'll do job very well. So we are very much looking for a thing. And is a 20 years of post qualification experience. He's a partner with SR Bartley Boy, and he's also related to the many social causes also. And he's also contributing to the Cancer Society also and doing a good job. केवल academic नहीं, but he's doing a good social services. He is in the trustees of two very renowned institutions. So Sanjeev ji, हम सब आतुर हैं. We are all waiting to hear from you. कि though this is applicable from financial year 21-22, why you are having this session now? And I think you have shared this with me, but मैं चाहता हूं कि आपकी जुबान सुने कि why you are presenting this 21-22 now in April 21. And there's a very good logic, rationale behind your this program, and I salute you for that. Now it's over to you, Sanjeev ji. Please, Sanjeev ji.
Thank you very much, Yagnesh bhai, my honorable council colleague and my elder brother in the council, CA Chiriniwas Yoshiji, who hails from the Western region. And Yagnesh bhai, you are also from the Western region.
Yes.
Let me tell you, Yoshiji is one of the most experienced council member, council colleague, and I have the privilege of sitting next to him in the council. So I always receive guidance from him, and generally the most complex tasks are assigned to him as the most experienced council colleague. And he is a member of nth group. I mean, there's hardly any group which is complete without Yoshiji, either as a convener or as a deputy convener. Recently has also been made as a deputy convener for the Center for Audit Quality, which is very, very important initiative of ICAI. He's also the vice chairman of the Assurance and Auditing Standard Board, besides being the Corporate Law Committee chair. He has been one of the panelists with me last year, which he was referring when the COVID-19 guidance came in. An amazing contributor to the entire CA profession, who has spent more than half of his professional life to the cause of the profession. I salute you, Yoshiji, and thanks a lot for giving me this opportunity for being part of the Corporate Law Committee program. And Yagnesh bhai, as you mentioned, that why we are doing this program now when it is applicable from next year, let me tell you, this is the second program. First program we did on 1st April. So right on day one, because chartered accountants acts as advisor, as an auditor. You know, they have to have the knowledge upfront before they advise to their client, or, you know, before they plan the year after, because they have to plan that what kind of changes are there. They have to educate the management. They have to educate their team. They have to sharpen your tool. I believe that, you know, on an average, if we spend 5 to 10% of our time in educating and upgrading ourselves, that is when we will be able to render effective services to the clients. And let me also tell you that there are few clauses. I'll just name one of them, although I'll be talking about all the clauses in detail from the company perspective. And two of my co-panelists, Amit Gupta and Sarika, CA Amit Gupta and CA Sarika, they will tell from the auditor's perspective. One of the clauses is that whether the quarterly stock and debtor statement submitted to the bank are in compliance with the, or are in agreement with the books of accounts. Now, if we inform the client this after the year end, they will say, why you not told us, why you not advised us during the year when we were about to submit our stock and debtor statement. So the first quarterly stock and debtor statement will be submitted on 30th of June this year. So naturally, the management must be aware that they must reconcile their books of account, because quarterly accounts are applicable only for the listed entities, where this clause is applicable for all the entities. So even if you are not a listed entity, even then you must reconcile your accounts on a periodic basis. I'll say rather one should do it on a monthly basis, not even on a quarterly basis. But this clause will force every company to ensure that the stock and debtor statement that they submit to the banks are in agreement with the books of accounts. Because if they are not, And if the auditor is going to give his audit report on the same and saying that the stock and debtor statements submitted to the bank are not in agreement with the books of accounts and there are major deviation, think of the possible implications on the company. So this is a forewarning, and that is why, because chartered accountants are the trusted advisor of the business. So they have to prepare themselves and their clients in advance. So that is why, ICAI always believe in capacity building of its members. So this program, which is the second I'm saying in 11 days, and there are number of programs which the branches, CP study circles, and the regional council are doing on the same topic, because we have 3 lakh plus members, and this topic is relevant for both members in industry as well as members in practice. So educating 3 lakh members, or even half of that, will take hundreds of such programs. So that is why, Yagnesh bhai, this program has been planned today.
That's it, sir. Thank you, Ji.
Thank you. And with this, now I'll share my screen, which contains the key changes on the Schedule 3, which have been brought about by this amendment, which Yoshiji talked about, that this amendment came in on 24th of March. Yagnesh bhai, can you tell me whether my screen is visible?
Yes, it is visible. It is visible. It is visible.
So we will be navigating the recent changes in Schedule 3 to the Companies Act 2013, and this will be followed by the discussion on CARO. Actually, I was a part of the CARO. There's a committee on CARO which was set up by the Ministry of Corporate Affairs, and as a CII representative, I participated in the same. Now, what happened is, when the CARO changes were being made out, then a point was that first, it is the management which should disclose the changes in its financial statement before the auditors report on it. And Ministry of Corporate Affairs found merit in it, and that's why they have introduced these changes in Schedule 3 as well. So first, the financial statements will contain this information, and then obviously the auditors will report in their CARO report on the same. So if you look at, as this amendment came on March 24, 2021, it amended the Schedule 3 to the Companies Act 2013. It amended the Companies Accounts Rule 2014. Though they have been now deferred by 1 year, this amendment, revised amendment came on 1st April, and the Companies Audit and Auditors Rules 2014. So two of the key changes, so some additional clauses on CARO, and one change relating to Audit Trail has been deferred by 1 year, and all other changes are applicable from 21-22. And also, not only this, the comparative also need to be given. So means 2021 financial statement would also need to be recasted by virtue of these changes. So hence, this is one more reason that even while preparing the financial statement for 2021, management should be careful. Auditors should also review whether the management will be in a position to provide those information or not. And I mean, particularly if you are guiding the management on the same. So as we said that these amendments are effective 1st April 2021, some people were under an impression that this could also apply for 2021. However, as Yoshiji said, we have clarified it from the Ministry of Corporate Affairs, and these are applicable in respect of financial year commencing on or after 1st April 2021. In the general instructions for preparation of balance sheet, it says that financial statement shall contain the corresponding amount comparative for the immediately preceding reporting period for all items shown in the financial statement, including notes. So which means that even the regulatory information which is required to be given need to have the comparative information. Now, the impact of these changes are that one is to start preparing for comparative information for the year ended March 31, 2022, and that comparative is going to be for 2021 financial year. And there are enhanced disclosures for companies, in fact, in all the three divisions, Division 1, Division 2, and Division 3. So Division 1 relates where there are Ind AS are not applicable, and Division 2 relates to Ind AS, and Division 3 pertains to the NBFCs. So one has to assess and make changes to the existing system, control and processes. And one should also look at the enhanced requirement under the CARO and gear up for the new IT infrastructure to meet the new disclosure requirements. Now, let me take you through these amendments into the Schedule 3, and I'll be discussing what was the old clause, what is the revised clause, and what is the type of change that has happened. In the general instruction itself, a change has happened. Depending upon the turnover of the company, the figures appearing in the financial statement may be rounded off as given below. Now, instead of turnover, now the new word is total income. And for that matter, even the P&L has undergone a change, and instead of total revenue, now the word uses total income. So that change one should note for the purpose of rounding off. Moving on to the balance sheet. See, as we all know that, the earlier, the nomenclature, some of the presentation requirement has been changed. We know that Accounting Standard 10, and I'm talking about Division 1, Accounting Standard 10 has been introduced, and the title of AS10, Accounting for Fixed Asset, was changed to Property, Plant and Equipment. However, in the Schedule 3, the word that was appearing still was tangible asset. So that has undergone a change now. I'll say this has been rectified now, and now the new word that is being used is property, plant and equipment. So this change has been made so that it corresponds to the change in the Indian GAAP which happened in 2016. Then on the share capital, a company is required to disclose promoter shareholding in the following manner, which Yoshiji was also talking about. This presentation can be in tabular form, where one has to give the information on shares held by the promoter at the end of the year. One has to give the promoter name, number of shares, the percentage of total share, and then of course the percentage change during the year. And then now the people ask that what is the meaning of a promoter? Promoter will mean the same as defined in the Companies Act 2013, and these details are to be given separately for each class of shares. And the percentage change is to be computed with respect to the number at the beginning of the year, or if there are shares issued during the year for the first time, then with respect to the date of issue. Now, there was another anomaly which has now been rectified, and this relates to the current maturities of long-term borrowing. So interestingly, earlier the current maturities of long-term borrowings were required to be disclosed under the other current liabilities, whereas actually in nature it's a short-term borrowing because this is repayable within 12 months. Say for example, there is a loan of 100 crore that's been taken and 10 crore is to be repaid within next 12 months. So in that case, this 10 crore which is repayable is actually in the nature of a short-term borrowing, and now this anomaly has been rectified, and now these will need to be disclosed under the head current maturities of as current maturity of long-term borrowing under the short-term borrowing, and obviously there is a corresponding change under the other current liabilities also. That's this requirement has been removed from there and inserted here. And then there is a very interesting information that needs to be given, and that is with respect to trade payable, and we will come to trade receivable as well, because similar requirement is there for trade receivables as well. Now an aging schedule is to be given for trade payables. So this will help in two ways. This will help the stakeholders, analyze that whether a company is making payment to its vendor in time or not. And secondly, it will also help them to analyze whether, what's the liquidity position and whether there is any possibility that the company will make a default. The aging schedule and for the purpose of aging schedule, one has to take the starting point as the due date of payment. But if no due date of payment is given, then it is the date of transaction. See, for example, if the date of transaction is today, 11th of April, and due date of payment is 30 days. So the due date of payment is mentioned, that the aging will count from 11th of May. But if due date is not mentioned, then the aging will start from 11th of April. So one has to disclose the dues which are less than 1 year, 1 to 2 year, 2 to 3 years, and more than 3 years outstanding. And again, these are to be classified into 4. Dues for MSMEs, both non-disputed dues as well as disputed dues. Disputed will be shown separately. And non-MSME trade payables. So MSME and others, and then one has to give a bifurcation between disputed as well. So if the total dues for MSME are 10 crore rupees, out of which disputed are 2 crore rupees, then one will show 2 crore under disputed and 8 crore under the MSME, which are non-disputed. And this, as I said, the aging schedule will be less than 1 year, 1 to 2 year, 2 to 3 year, and more than 3 years. And then, as Yoshiji said, one very, very important change which is there is unbilled dues. So unbilled dues also needs to be given. And this is again on both sides, unbilled revenue as well as unbilled dues. So maybe the bills have not been received, but a liability has been incurred. So they also needs to be disclosed separately. Moving on, for the other current liability, we have already discussed point number G, so I'll not repeat it. Moving on to L, point L, long-term loans and advances. Earlier, security deposits were a part of long-term loans and advances. These have been moved from here to the heading other non-current asset or other financial asset for India's companies. So you'll find this change over there as well. For the tangible assets, one change has been made to align it with the changes in the Caro report. And this relates to one, as we said, the nomenclature change, but that's pretty simple. Property, plant and equipment. Now in Caro, a change was made. That's why there is a corresponding change here. It says that if a change is 10% or more in the aggregate of the net carrying value of each class of PPE on account of revaluation, then that change is to be disclosed separately. So that's a welcome change. If the change arising out of revaluation is more than 10% of the net carrying amount of each class of PPE. So if there are 10 classes of PPE and there is a change in 2 classes of PPE and the change on account of revaluation is more than 10%, then that is to be disclosed separately. And similar disclosures are required for intangible assets as well. I'll not talk about Caro because 2 of my other colleagues, my other panelists are there. So they will talk about what needs to be done by the auditor on the same. Then on the other non-current asset, as I discussed, it's been removed from the long-term loans and advances, security deposit, and this is to be now disclosed under the other non-current assets. Then on trade receivables, there is a very, very important change which has happened, and that relates to the aging schedule. And this is similar to what we discussed in trade payables. And here, rather, it is more elaborate because for trade receivable, we always have been disclosing dues which are less than 6 months old. So that less than 6 months has been retained, and a new category of 6 months to 1 year, 1 to 2 year, 2 to 3 year, and more than 3 years has been introduced. And again, outstanding will be computed from the due date of payment. And if no due date of payment is mentioned, then it will be considered from the date of transaction. And 4 classification needs to be made for the companies which are following accounting standard. These are undisputed trade receivables considered good, undisputed trade receivable considered doubtful, disputed trade receivable considered good, and disputed trade receivable considered doubtful, again on the lines of trade payables. For India's companies, instead of 4, there are 6 classifications. These are undisputed trade receivable considered good, undisputed trade receivable which have significant increase in credit risk, and undisputed trade receivable which are credit impaired, which means doubtful, and then similar classification for the disputed trade receivables needs to be given. And then more importantly, the unbilled dues shall be disclosed separately. See, the background of these changes which are being made, the government wants to address the red flags, because if there are long-standing unbilled revenues, then obviously this could be a red flag that is it that the revenue is being recognized only through book entries, but no billing has been done. So many of the clauses in the Schedule 3 through the changes actually are addressing the red flag or the early warning signal, both in the Caro report as well as in the Schedule 3. These are, in fact, what happens is when voluntarily, the regulations or the expectations are not being met, then that pushes the regulators to introduce the changes by changing the law. Same thing has happened in respect to Schedule 3 as well as Caro as well. Now, another change, this is a new clause where the company has not used the borrowing from banks and financial institutions for the specific purpose for which it was taken at the balance sheet date, then the company shall disclose the details of where they have been used. So if you take money from bank for a specific purpose, and if you don't use it for that purpose, then you are required to disclose the purpose for which you have used it. And then earlier, the company was required to disclose whether, in the opinion of the board, any of the asset other than PPE and non-current investment do not have a value on realization in the ordinary course of business, at least the value to the amount at which they are stated. The fact that the board is of the opinion shall be stated. Now, apart from PPE, the word intangible asset has also been included into it. Now, very important additional regulatory information is to be included now in the Schedule 3. One relates to the title deeds of the immovable property. So, if the title deeds of the immovable property are not held in the name of the company, then that needs to be disclosed in a format which is in line with Caro. So I'm sure that Amit Gupta or Sarika will discuss that. I don't want to repeat it. And such disclosure shall be for PP, investment property, PP retired from active use and held for disposal, and others. And this format is very informative format. And the idea is to bring to the light the chances where the immovable property is not held by the company in the name, in its name, and rather in whose name it is being held. That also needs to be mentioned. Again, where the company has revalued its PPE, company shall disclose as to whether the revaluation is based on the valuation by a registered valuer or not. And another important, in fact, Yagnesh Bhai mentioned in the beginning, what are the important changes? So there are so many important changes, and I believe this third change is also very, very important. See, sometimes loans and advances are given to promoters, directors, KMPs, and the related party, and the terms of repayment are not specified. So now it will need to be mentioned that how much loans and advances are there which are granted to promoter, director, KMPs, which are repayable on demand or without specifying any terms or period of repayment. So this will help bringing in a lot of discipline. On the capital work in progress, again, very useful information needs to be given. For capital work in progress, the aging schedule needs to be given. So for the projects in progress and projects temporarily suspended, what is the amount of capital work in progress for a period of less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 years. And they should tally with the amount in the balance sheet. And this could also help in identifying the early signals for the need for impairment testing. And not only this, there's an additional schedule which needs to be given. And it is where the CWIP is overdue for completion or has exceeded its cost compared to the original plan, both. So time and cost overrun are to be mentioned. And here again, the plan is to be given whether it will be completed in less than 1 year, 1 to 2 year, 2 to 3 years, or more than 3 years. And the details of the project where the activities have been suspended shall be given separately. So again, very detailed information is being asked for. So the information, normally this is the kind of information, which the Ministry of Corporate Affairs or its various agencies used to ask when they used to carry out a detailed review or a detailed investigation. But now they want that information is to be given in the financial statement itself. And so while for capital work in progress, that requirement has been introduced, the same requirement has been introduced for intangible assets under development as well. What is the completion schedule? And in case there are any time and cost overrun, the information relating to the same also needs to be given. Moving on to the Benami property, Since the auditors are required to report on the Benami Property instances, the company is also required to give in its financial statement the details of such property, what is the amount, who are the beneficiaries, whether the property is in the books or not, if not, then why it is not, and what are the proceedings against the company which have happened in case they have happened, and what is the company's views on the same. Then again, this is very, very important change, which I mentioned in the beginning, that why it is necessary to understand these requirements now, where the company has borrowings from banks or financial institutions on the basis of security of current asset, that is the cash credit limits. It shall disclose the following: whether the quarterly return or statement of current assets filed by the company with banks or financial institutions are in agreement with the books of accounts or not, and if not, then what is the reason for the same. That needs to be adequately disclosed. Then a clause on willful defaulter. One has to give, if a company has been declared as a willful defaulter by any bank or financial institution or other lender, then the following details shall be given: the date of declaration as willful defaulter and what are the details of those defaults. Then another very important clause is relationship with the stuck-off companies. The companies whose name has been stuck off under Section 248 of the Companies Act 2013 or Section 560 of the Companies Act 1956. The company will give the following details. And why this information is required to be given? Because if the name has been stuck off, the recovery may be doubtful. So one is to give the name of stuck-off companies, the nature of transaction with those stuck-off companies, whether it's investment in securities or receivables or payables or share held by stuck-off companies and other outstanding balances. And what's the balance outstanding? And what is the relationship with the stuck-off companies? Is it a related party or is it not a related party? Then an information on registration of charges or satisfaction with the ROC, whether any charges or satisfaction yet to be registered with the ROC beyond the statutory period, and details and reason thereof should be disclosed. Then compliance with the number of layer of companies. Now under Section 287, 2 layers are allowed. So one also has to mention whether the compliance has happened with the number of layers of the companies or not. And then again, a ratio analysis needs to be given in the financial statement. Normally, it's the job of the analyst that they carry out a ratio analysis. But to maintain consistency, now in Schedule 3 itself, the ratio analysis needs to be given. And as Chiriniwas Yoshiji mentioned in the beginning, this will be very, very useful for also assessing whether the company is a going concern or not. And one very important insertion has been that if any ratio has changed by more than 25% as compared to the preceding year, that also needs to be disclosed along with an explanation that why this has happened. Some of the ratios which needs to be given, in fact, is a detailed list: current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover, trade receivable turnover, trade payable turnover, net capital turnover, net profit ratio, return on capital employed, and return on investment. So while the MCA has not given any formula for computing the same, but you can expect the guidance will come from ICAI for the same. Then one also has to talk about whether the company has complied with the scheme of arrangements or not, and the utilization of the borrowed funds and the share premium, that how this has been utilized. And similarly, whether company has received the money or company has given the money. In both, although for Caro this has been deferred for 1 more year. Now, from balance sheet, now let us move on to P&L. So as we said, now instead of total revenue, the word used is total income. So revenue from operation and other income, and the nomenclature is total income under Indian GAAP. In addition, now there is a new insertion for Ind AS companies, and one has to disclose under revenue from operation grants or donations received, and this is relevant only for Section 8 companies. Then one also has to give an undisclosed income. Now the income which the company has not disclosed earlier, but now has surrendered to the tax authorities, unless there is an immunity for disclosure under any scheme. For example, if it is VDIS and there is an immunity for not disclosing the same, but if that immunity is not there, then one has to state clearly undisclosed income, and shall also state whether the previously unrecorded income and related assets have been properly recorded in the books of account during the year or not. So this is going to be very, very onerous kind of a disclosure. For CSR, the responsibility has been immensely increased, and accordingly, the Schedule 3 disclosures have also undergone change. And it says now the company covered under Section 135 of the Companies Act, they shall disclose the following: amount required to be spent and how much they have spent. What is the shortfall? What is the previous year shortfall? And what are the reasons for shortfall? What are the kind of CSR activities? What are the detail of related party transaction? For example, if the contribution has been given to a trust and whether a provision is made for the balance liability or not. And now it is no longer a comply or explain provision. Now it's mandatory. And if you are not willing to spend, then you have to transfer it to special fund to be maintained by the government. Then a new disclosure is there on the detail of the cryptocurrency or the virtual currencies. Of course, through this disclosure, some people are of the opinion that holding cryptocurrencies have been legitimized. But I don't think that by virtue of Schedule 3, these can be legitimized. Only a disclosure is required in the Schedule 3, and whether these are legitimate or not, that will be decided by the Reserve Bank of India. The additional changes in Division 2, in addition to what we discussed in Division 1, are in the balance sheet on the non-current liabilities and current liabilities. There is another line item with respect to lease liability that have been added. And for the other financial asset, now bank deposits with more than 12 months maturity needs to be specifically disclosed. And there's another heading, which is other financial asset, which is an all-inclusive heading, and which can be used for disclosing items such as security deposits. Then in case, apart from what we discussed for Division 1, two more changes have happened for Division 2. One, if the company shall disclose either whether the fair value of investment property, which is required to be disclosed under Ind AS 40, is based on the valuation by a registered valuer or not, and where the company has revalued its intangible asset, whether those have been revalued on the basis of a valuation by a registered valuer or not. Then there are some changes in the statement of the changes in equity as well in the presentation format. And then for the NBFCs, they also have to disclose, some of the additional ratios, which are capital to risk weighted asset ratio, Tier 1 TRAR, Tier 2 CRAR, and the liquidity coverage ratio. And one very important change, which have now been deferred by 1 year, is Audit Trail. Every company which uses an accounting software for maintaining its books of account shall use only such accounting software, which is a feature of recording audit trail of each and every transaction, creating an edit log of each change made in the books of accounts, along with the date when such changes were made, and ensuring that the audit trail cannot be disabled. So say, for example, if a company is using a software, Tally or Busy or SAP or Oracle, or for that matter, any other software, so then the company has to ensure that this software has a feature, and that feature has been enabled, and the feature cannot be disabled, that any change that you make, for example, you want to rectify an entry. There are many people who says, now does it mean that if there is an error which has happened, now we cannot, rectify that error? No, certainly you can rectify that error, but rectify that error not by deleting that entry in your books of accounts. Pass a rectification entry, which all of us have learned being a commerce student. Pass a rectification entry. People also say, now, does it mean that books of accounts, the entries have to be done on a daily basis? Well, yes, entries must be done on a daily basis, but it doesn't mean that if you are not able to do an entry on a particular day, you cannot enter it on the next day. You can do that, but yes, the date will be the current date. You cannot go back to that date. Again, people ask a question, if 31st March has passed and we have to pass some entries, which are the year-end entries, whether we can pass those entries on 30th April or not. Certainly you can do that. Certainly. These will be dated 31st March. This will be passed on 30th of April. And the edit log will clearly indicate that these were passed on 30th April. And there is nothing wrong in it. The year-end closing entries will be passed till the time the audit is going on. But what it means is that this edit log is available, that when did you do the entry, if you deleted any entry or not. And now, to give more time to the companies to comply with this, the government has shifted the date by 1 year, and this change was made on 1st of April 2021. So with this, Yignesh Bhai, I would like to end my presentation, and over to you now, Yignesh Bhai. If there'll be any questions, I'll be happy to take it at the end. Thank you very much.
Sanjuji, very, very comprehensive deliberation. And I'd like to ask you one question, if you don't mind. So you have narrated so many changes in great detail, but which change, in your opinion, is more important, or which change you'll rate a very important change, sir?
I think, let me tell you, as you said, all changes are important, but two changes will be path-breaking changes. One is this audit trail, which needs to be maintained, although now that's been shifted by 1 year, which is good, which will give the companies time to comply. And secondly, this quarterly statement to the banks, that needs to be in agreement with the books of account. I think that will bring in a lot of discipline, Yignesh Bhai.
Yes, I concur with you. And no wonder that you were on the board of at least 16 groups and all these, that you are able to so comprehensively dwell on all the items covered in the...
Now I am a member of 31 committees of ICAI.
31 committees. I think I don't have the updated information. 31 committees. Kudos to you, sir. Okay, very good deliberation, sir. And now, friends, we have the second speaker in terms of Mr. C.A. Amit Gupta. And he's a fellow member of ICAI and a partner with S.R. Bartleby and Company. He has 23 years of experience in auditing companies, especially power and utility companies and the real estate and the infrastructure companies. He's a commerce graduate from Sri Ram College of Delhi. So again, sir, another gentleman from Delhi, and he's an avid speaker, and we'll witness his speaking abilities today and the way he explains. And I've heard about Amitji that he's a very, very, very good speaker, and he has a capacity to mesmerizing the audience. Yes, sir. So we'll see Amitji, and Amitji will dwell upon the Caro, am I right? Amitji,
That's
sir?
right.
That's right. Upon the Caro, okay? And Caro has been divided in between Amitji and Sarika. So I think Amit Gupta will speak on about 10 items on the Caro. So let's hear from Amitji. Amitji, please, its floor is all yours.
Thank you, Yignesh Bhai. I think I sometimes get worried with the kind of introduction you give. So you set up the big contest and it becomes big shoes to fill in. But I'll try. So thank you so much, Yoshiji, for giving an opportunity as a part of Corporate Law and Corporate Governance Committee of ICAI. Respected Sanjeev Singhal-ji and T.A. Sarika Gosaev. Happy to share the discussion and share my perspective on a few clauses of Caro. We will do more sequential as the program says, clause by clause. I'll do first 10 clauses and then Sarika can take the other 10 to have you a different perspective. Let me just share my screen first. And so Yignesh Bhai, let me know when my screen is visible.
Yes, Amit, your screen is visible.
Okay, great. So I think, one, Sanjeev ji covered a very important topic of what companies are supposed to do in terms of, and the government is asking more and more responsibility from the companies to share more information. And of course, the auditors also will have to share more information. That is, I think, the order of the day. And that's how this company's auditors audit report 2020 came in. If you all recall, the last one was 2016. So it has been, a few years in between, and there have been changes in the last few years, which has warranted this new report to come in. And I will share some of the reasons why this has come in. Essentially, if you look at, there has been recent instances of frauds getting reported. If you look at last 2 to 3 years, they were, if you look at media, and I'm sure all of you are seeing it, there are questions around fund diversion, unaccounted cash, misappropriation, inventories. There was, of course, increased pressure on the regulators to demonstrate what really they are doing. If there are increase in suspect of frauds, are we doing something about it? And that is how Caro was brought in. And of course, the idea was, how do we bring more information to the regulators right at the first instance? The users of the financial statements, can they read the auditor's report and try to see that, okay, I get this information, which is helpful. And as Sanjeev said, we can look at all the red flags at the first instance rather than things going wrong and do a kind of a postmortem analysis. So there is a increased accountability, responsibility, and reporting by the statutory auditor, significantly enhanced. And I must say this is very big change. Post, I would say the Ind AS coming in for certain companies, this would be the second biggest change which will be coming to the auditors fraternity, specifically on the audit and companies accounts bookkeeping side. So this is how Caro was brought in. And moving on, okay. And I think the other piece is what was happening in the macroeconomic environment. So you would have seen, maybe not last year, but the year before, there were a lot of last minute audit resignations were coming in. There were reports around evergreening of loans. There were certain companies who suddenly, the auditors would have given a clean report, and suddenly next quarter, they would come up and say, no, we have a going concern issue. We are not able to make the payments on time. And, corporate social responsibilities funds were not used properly. There was the challenge that whether the internal audit function is really working in the manner which was designed it to be. Who is following up really on the internal audit function? Are they really effective? Is there somebody as an oversight commenting on that? The money was floating around between group companies and to related, unrelated parties. Again, not much of reporting. And then there were whistleblower complaints which were coming in, which were just going down pile in the company system, but again, not brought into the public. So the idea was, can we bring some of these areas? And that pretty much became the theme, saying, how do we kind of plug in? And, you can imagine with the kind of information put under the slide, there were too many things which the regulators have tried to address in this new Caro and try to capture every bit of it to give the readers a bird's eye view of what exactly is happening in the company. Okay, moving on. And of course, I think the big change is, I would say this now applicable from 2021, not really 2020. The applicability does not remain, it remains unchanged. It still does not apply to banking companies, insurance companies. I would say private companies within the threshold, but those companies would be really very small. They are talking of a paid up capital and reserves of 1 crore, less than that, borrowings of less than 1 crore, turnover of less than 10 crores. Now, I would say that's another thing which is very important for all of you to note, that when you are working with your clients, this will be pretty much applicable to large scale of companies, because the thresholds are so low, there is no kind of an escape to say that, oh, we are a smaller company, so we don't have to answer all the clauses. All the clauses have to be answered then. And of course, one other important piece comes in, what happens to consolidated. If you are a group having multiple subsidiaries, joint ventures, associates, does it apply to the consolidated financial statements or is it only to the standalone? So, of course, only one clause applies to the consolidated, and my fellow speaker Sarika will talk more about it, so I will kind of defer it now. But this is how the changes look like. So, this really, of course, there are 21 large clauses, but in each of the clause there are 6 or 7, sub clauses. Some of them have 6, some of them 3. And that's how if you put all the sub clauses together, they are close to 50 new total reporting requirements, out of which 28 are new. 16 are significantly modified, 7 are carried forward, and 1 is deleted relating to managerial remuneration, which was pretty much a duplication in the main report and the Caro report. So that's how, there will be almost a 50 item reporting. So people who are chartered accountants, even for people who are in the corporate setup right now attending this webinar, this could be a significant amount of effort both for the auditors as well as for the companies. So whenever you are discussing for the next year, this becomes an important piece to talk about in terms of the increased effort and the kind of time the auditors will have to spend to report on each of the 50 clauses. Okay, so as I said, I will move on to the clause by clause analysis. I will take from Roman I to Roman X, which is first 10 clauses. It almost, when I say 10 clauses, essentially it has 29, 30 sub clauses. That's how the reporting looks like, and that's what we are supposed to do. So on the first one, on the property, plant and equipment and intangible assets, I think the initial disclosure requirement, there was already a disclosure requirement under the old Caro. The Caro of 2016, I'll call it as an old Caro here. And the new one actually has now added that the auditors will have to report whether companies have maintained proper records showing full particulars of intangible assets also. So intangible assets, all the softwares, all the licenses, what's the license key, what's the description, what's the version, what's the amortization charge. Now, it was primarily focused to only the tangible assets earlier. Now, the fixed asset register has to be maintained for intangible assets also. Now, that's again, important for companies which are using a lot of amount of software and, what version, what licenses are kept. So that's an important exercise that needs to be undertaken both by companies and, of course, for auditors to report on it. The next one is around the revaluation. This is in line with what is the change in the Schedule 3, what Sanjuji just mentioned, that in case there is a revaluation of property, plant and equipment, or including a right to use asset, then, the auditor has to report whether the revaluation is done by a registered valuer. And if there is any change in the value more than 10% in aggregate for each class of PP&E, then that change has to be brought in. So again, there is a section 247 requirement, all of you are aware of, that how a registered valuer should be appointed, he should be impartial, and all the compliance with that 247 has to be done. So that again is an important piece. What happens on revaluation, that's a new reporting requirement. The other one is around the intangible assets records keeping. The next one is around the immovable property where title deeds are not held in the name of the company. Again, this is in mirror to what was there in Schedule 3. What Sanjeevji said, the companies will disclose that and auditors will make a separate reporting in their CARO that we have validated this information. And what this would mean is, excuse me, what this would mean is that, let's say, and I think the biggest change is not really, in my personal view, whenever we have spoken to several companies, they say that there is now a very clear requirement, which was not there in the earlier CARO, about the leasehold land and building. So if you have an immovable property which is on a lease basis and the company is a lessee, then the lease agreements have to be duly executed in favor of the company. If those are not there, then those also need to be reported. Because while the title deed could be where you are actually holding a freehold property, but even for leasehold, just for summarization, those have to be duly executed. Now, you can imagine a company which say, let's say, I was talking to a company which is a fast food joint. Now, they have maybe 500 stores. A company which is a retail product company which has retail stores, 200 stores in the country. Now, for each one of them, they have to make sure that there are lease agreements in place where they have taken the premises on lease, because those are immovable properties. Those are duly registered. Now, again, there is a debate in the world whether, executed would mean registered or not really registered. But again, that something is an exercise which has to be done for every place, every small city, wherever they have an office which has an immovable property. All the agreements have to be put in place and auditors will have to validate that. Today, we would be doing test check, but in this CARO, you will have to do more detailed about which of them are not duly executed. So it pretty much becomes 100% analysis that way. So other than this, I think the PP&E, whether it's reasonably and physically verified at reasonable intervals, that continues as it is. So that is a continuation. But the three clauses which has come in 3.1, which is around the title deeds, which is around revaluation, and which is around proper records of intangible assets. Moving on to the next clause is about, and in fact, before that, I think there's another one which is on the Benami Property. And again, this is there a reporting for the company now in Schedule 3, and also for the auditor whether any proceedings have been initiated or pending against the company for holding Benami Property. Again, very important, Benami is very clearly defined under the Act, in which a property is transferred to one person for consideration paid by another person. That really is Benami. Now, companies will have to lay down the control to identify such items and make a disclosure. And of course, auditors will have to make inquiries from the legal head, from review of the board minutes. And there's a lot of procedures you have to make sure, look at the public knowledge and say that are there any such proceedings which have been initiated or pending against the company. So that's where I am on the clause 3.1. Moving on, the next clause around inventories. Again, this was already there, but this has been again significantly verified. As my learned speaker just mentioned before this, very important change which has come is around, all this submission to the banks, on a quarterly basis. So in case any company has a working capital limit sanctioned, which is greater than 5 crores in aggregate from banks or FI on the security of current assets, which could be inventories, it could be receivables at any time during the year, then the auditors will have to see what has been reported as a stock statement on the quarterly basis. Are those in agreement with the books of account? If those are not, then that means that has to be reported. It's again, you look at it for companies which are not listed today and they submit quarterly statements. Now, auditors will have to look at the June quarter, the September quarter for an unlisted company. Maybe for a listed company, still there are some quarterly procedures being done. So companies would be more kind of thorough there. But the idea is today the regulators are expecting the companies as well as the auditors to make sure that these are reported and brought out very clearly. And the requirement here is it's only sanctioned working capital limit of 5 crore, very small amount and sanctioned. So it's not that you have to utilize a 5 crore limit. If you just got it sanctioned, then also whatever has been submitted, auditors will have to look at it and see whether those are matching with the books of account. So again, very, very important. And I think it's very high time to go to your clients and tell them that this change, because the CARO is already being deferred now, maybe next year may not. So by 30th June, they should be ready to get these things done rather than waiting at the end of the year. So you go in 22 for audits and then say in March 22, June quarter or September quarter, there's a problem. There's nothing can be done. So it's something which should be looked at more proactively. Moving on, the other one was on the inventory physical verification. The clause actually said 3.2 that the physical verification is done at regular intervals and any discrepancies noted. Now they have actually added 2 more pieces to it, which says the auditors have to report on the appropriateness of coverage and procedures. Now, whether the coverage was right, what procedures were performed by the management. And the word they use is appropriateness. Now, appropriateness is very judgmental. What is really appropriate for a company of that size and scale will be an individual judgment. And of course, if there are discrepancies more than 10%, and actually 10% defined in the guidance note more as in value, not really quantity, for each class of inventory, then how it has been dealt with in the books of accounts. So there will be again, going through the management has to now retain all their stock verification sheets. If they are doing a half-yearly physical verification for an unlisted company, they will have to keep all the written instructions, what have they, physical verification sheets, what memo, how they did, because the auditors will have to look at this and comment in the CARO in year end, how the coverage was there and what procedures were performed for physical verification. Okay, moving on. The investment guarantees. I think this clause 3III is I would say, one of the most fundamental one. It has 6 sub clauses in it. If you earlier recall, this was a clause talking about loans and advances to Section 189 parties. Now, the loans and advances have been changed to investments, guarantees, securities, loans as well, and advances in the nature of loans. Again, advances in the nature of loans is not really defined, but they are like now instead of only loans reporting, this is the reporting around investments, guarantees, security, loans, and advances in the nature of loans. That's one piece. Second is that it is now not only related to Section 189 parties, but it applies to any company, any firm, any LLP, any other parties. So the clause has become very broad. What is the reporting then? The reporting is that in case you have done any investments, given guarantees, provided securities and all of that, you have to report what is the amount of that investment and guarantee given and what is the balance outstanding at year end in respect of a subsidiary, JV and associates, and also in respect of companies other than subsidiary, JVs and associate. So the government wants to see, or the readers, they should tell the readers that how much pertains to subsidiary, JV and associate and how much pertains to other parties. And then that brings you to actually to the next clause. The next clause then says is whether the investment made guarantees and securities and these terms of those grant are not prejudicial to the interest of the company. Now, if you earlier recall, it was only restricted to saying whether the terms of the loan are prejudicial to the interest of the company. Now it is saying whether you have made the investments or any guarantees. Now, let's say a holding company makes an investment in a subsidiary. You make a 10% investment in a startup and the startup goes bad. Now, the question could be whether this is prejudicial. So there could be debates because there could be some hindsight. What kind of records are maintained at that point of time by the company, which are seen by the auditors, documented as per relevant standard on auditing, to say that the investment made at that point of time looked not prejudicial to the interest of the company. whether the guarantee given, you have given a guarantee for a related party, you have given a guarantee for a non-related party, whether that is prejudicial. Now that's again a very overarching comment which auditor has to make, very judgmental, but again it has to be backed up by a lot of documentation by the company and of course kept by the auditors in his files. Moving on, again related to investment guarantees, the same clause 3 III, whether there is any renewal or extension of loans which has fallen due during there, and aggregate of such amounts which are there, percentage of such loans. So what it's saying, is there any loans which have fallen due during there or any fresh loans have been granted? What is the percentage of that? If there is, you actually will extend a loan or you give a fresh loan to settle the earlier loan, that all has to be reported. If there are any loans and advances granted without stipulating any terms, so you would see under Ind AS, a lot of people will do a 11-month loan advance, a short-term loan advance, which really does not classify anything. Now it says that if the repayment period is not there or it is really short-term, then all those loans have to be reported vis-a-vis the total loans. That have to be brought out in the report, and you can imagine for companies which are having several subsidiaries, it's a holdco, what kind of a detailed report this will look like. So again, just to summarize, for all of this, the company will have to set up a very strong control. And of course, then it is for the auditors to look at each of these items and report on it. So the report may run into several pages, but that's how it is. And we have to be very careful about, reporting on such items. Moving on, I think section 185 and section 186, there is no change in this one. This is clause 3 IV, clause 3 Roman 4. And of course, the provision of 185, 186 has been complied with. So I will not dwell further on this in the interest of time, so that we can have some more time for the Q&A at the end of this session. The next one is 3 Roman 5. This is around, I think one important change, this is around the deposits, the public deposits, whether the RBI directions and section 73 to 76 were complied with. This was there since long, but I think they just added the word which are deemed to be deposits. Now, deemed deposits are covered under this clause, and deemed deposits is a very tricky term, because essentially if you look at the deposit rules, it actually says that any amount which is can be deemed to be deposit on the expiry of 15 days from the date they become due for refund. And what that would mean is, it gives an example that let's say you give an advance for a supply of goods and services, and that advance is not settled within 365 days. So the moment it becomes refundable, within 15 days thereafter, it will become as a deemed to be a deposit under deposit rules. And now that reporting triggers. So again, that's the kind of detailing the companies have to look at and auditors have to be sure about it. But that's one important change which has to be considered as we move forward. Okay, moving on is around the maintenance of cost records. Again, this is not a very significant change. So this is pretty much the same. There are absolutely no change in this one, whether the companies had made and maintained cost records. So this will continue as it is. Clause 3.7, payment of statutory dues. Again, this has become very extensive now. Very small, subtle changes which have been brought into the clause, highlighted in red there in the screen, but not really. So they've added GST, which is the new act which they've added, which is fine. But actually now the clause B, which was saying that whether statutory dues pertaining to ESI, PA, income tax and all of that, has now been said the dues referred to in subclause A. What that would mean is subclause A actually says any other statutory dues also, which means when there is any statutory dues which has not been deposited on account of dispute, that has to be reported. So previously it was only 3 or 4: income tax, sales tax, service tax, custom duty, excise. Now this is all statutory dues. So there is any statutory dues which has not been deposited on account of dispute, that has to be brought in. Amount involved, forum which is pending. It can go into pages, this report. But again, this is where the auditors will have to be comfortable. Look at the management system of identifying their compliances with these laws and regulations. What are the statutory dues applicable? Which of them have not been deposited? Where all the dispute is happening? And all of them gets reported now in the new CARO. Okay, moving on. Okay, this I think Sanjeev ji talked about the unrecorded income or surrender of income. there's a new clause which actually says that in case the transactions, auditors will have to report if the transaction not recorded in the books of account have been surrendered, discloses income during the year in the tax assessment, and whether this has been properly recorded for in the books of account. So there could be instances where there is actually a surrender of income, or you disclose during tax assessment that, okay, I confirm as an SSE that we are disclosing this as income for the year. Now, in that situation, we have to look at report the same thing as well as also say whether this has been properly accounted for in the books of accounts. Now, you can just imagine the kind of issues which comes in this. I just one or two off top of my head is that, let's say this is income pertains to 3 years back, an assessment is happening in this year, and the company says that, okay, this is the amount which I surrender, or this is the amount I go to. Now there's no longer a settlement commission is going away, but let's say you go to a settlement commission in the earlier thing and say that this is the income I want to surrender. In that case, the question will not only be Caro reporting, that will be of course there, but there will be also a question on the audit, what really was done, why this income was not disclosed in the books. Are there anything which was failure of the audit? Are there any management override of controls? Or is there, let's say from an Ind AS perspective, is that a prior period item, which means a restatement in the earlier year depending on the materiality. Now, those kind of things will have to be looked at. So this clause will not only stay here, it will maybe pose a lot more questions, as Sanjeevji said, and that's something which have to be looked at. Okay, the next one is again very interesting, is around the other side. We talked about the investments and loans. I think this is about, when the company has taken the loans and borrowings. So again, this has been very extensive. Initially, it says whether the company is defaulted in repayment of dues to banks, financial institutions, government and debenture holders. Now they are saying whether there is a default to any lender. Any lender has to be reported. Again, they've just not restricted to 4 lenders, but they've expanded it very significantly. And of course, there is like 4 or 5 new thing, whether the company is declared a willful defaulter. Again, the Schedule 3, this is mirrored from Schedule 3 as we discussed earlier. If terms loans were applied for the purpose this were obtained, if no, the amount of the loan so diverted and purpose for its use. So again, there is a diversion whole circular there in RBI, but they're asking whether the term loan are applied for the purpose for which they're obtained. Again, the next kind was this is if short-term funds are utilized for long-term. This was there in the the Caro before 2016, but this was removed in Caro 2016. Now they're bringing it back. This should be balance sheet position. If you have taken any loans to meet the obligation of the subsidiary, associate or JV, that again is very important. And the last one is if the company has raised loan during the year on pledge of securities held in subsidiaries. So that again is very important, which we have to see. So there are like 5 of them, which has to be taken care of. Yeah, Yagneshji, you.
Just don't wait. Go for 1 minute more, please.
Yeah, okay. Yeah, that's right. So I think I'm just pretty much on the last slide. So I think these are the 5 clauses which are very relevant for this one. And the last one is around the preferential allotment. So there's no change in this one. There's just a small thing. Only it talked about private placement. Now the auditor have to say even in preferential allotment are there and the funds have been utilized for the purpose for which they are obtained. So that is the clauses which I have. And then now I kind of pass on the baton to Yagneshji so that my fellow speaker can take on the other clauses. Thank you so much.
Thank you, Amitji, for a very, very great deliberation, and I really appreciate it. In the meanwhile, Joshi sir, are you there on the line? Joshiji sir, are you there,
yes,
Chairman
yes,
sir?
Yes.
I have one simple question that this revised Schedule 3 requirement will be applicable to the quarterly reporting, sir, for 21-22?
Yeah, I'll take 2 minutes on this because I said this is Caro itself is applicable from 22. I said already. Now the thing is the quarterly results for listed company is only limited review, which clearly says that is not audit. It is not based on audited statements. Now, if there is an audit, there is a Caro. Caro will be applicable to the accounts for 21-22. So even if you are having suppose accounts of December ending, for example, it will be still applicable. So it is rightly said that there what auditor is supposed to see that there is a quarterly statement of stock and debtors, which whether it is matching with the statement, with the accounts, with the statement given to the bank. Now the thing is, I want to take 2 minutes why I'm telling you. One is, auditors always have seen this for March quarter. For example, they want to see whether what is given to bank is same as in the balance sheet, because bankers also verify this. But they don't verify for the first 3 quarters. That is why these clauses come. And here, what I am trying to tell you is, when I am checking, means some addition to that, when I am checking in March also, what I should see is not only that it matches, all the things match. For example, if the customer, that is my client, has said that 90 days debtors he has given, suppose, and above 90 days, even that should tally to my accounts. Generally, there is a tendency of the borrowers not to give these 90 days or to give false information. They may not give, they may give return of debtors to the bank. They may give disputed debtors to the bank. They may not give creditors to the bank. They may not give related party. They may add related party debtors when they are not to be added as per sanction letter. You know, when you are saying correct statement is given to the bank, even the sanction letter of the bank becomes important. There are many things to be seen in this, sir. As far as this is as far as debtor, but stock also. Stock under LC is not to be taken. Stock which is received from third party for machining is not to be taken. Packing stock against packing credit is not to be taken. So there are many issues, whether non-moving stock should be taken, whether the stock slow moving should be taken, whether outdated stock kept in a pledge godown should be reported. There are many issues in this for the profession as such. This is what my take is, but again, in quarterly report being a limited review, it will not be there. It will be done at the end of the debate. I am asking profession to be very, very cautious. What should be in stock, what should be in debtor is also important. Reporting all creditors is important. This clause is very critical, as Sanjuji said, and as our current speaker also said. But then you have to have lot of other guidance required on this. And and one of the things, sir, even if you are not asking, one of the clauses on which this our current speaker spoke about is about the disclosure to income tax regarding, suppose, the undisclosed income. Friends, only 1 minute, half a minute I'd like to take. Undisclosed income. Speaker has rightly said, if it is for the prior year, then you have to write in the prior year in tax audit report, etc. Right? The main question for me is, as an auditor, is if there is an undisclosed income of a substantial amount by the assessee in the raid or in the survey, what happens to my IFC? Internal financial controls. I have always stated my billing was right, my stock was right. Everything, you know, what happens to that? If that itself is under question, the whole, you know, structure of audit based on this is under doubt for me. And it's a very, very important clause that I should answer, and have other things also thought of, like the speaker said. Thank you, sir. Thanks a lot.
Sir, thank you so much. Thank you so much. And now we have the last speaker, and for a change, and she is Sarika Gunsavi, and she is a chartered accountant and company secretary both, and she has been actively associated with the ICAI activities. She has been a regular speaker on the ICAI platform and also ICSI platform. She has got 18 years of the post qualification experience, and she is heading the technical functions of the Mazars India, and taking care of the accounting advisory, issuing thoughtful leadership publications and training. Oh, she's very much into training. And I believe she is also the faculty members of the ICAI certificate course. So Sarikaji, we are very eager to hear from you. And I believe you are going to complete the second part of the Karo. In the meanwhile, Sanjeevji has sent me one SMS about the Benami properties, which I'll read out after Sarika's deliberation. And friends, one more announcement: the presentations have been uploaded on the portal. And we'll take the question answer session after Sarikaji's deliberation. So the floor is yours, Sarikaji. All the best to you.
Thank you so much, sir. And again, as Amit said, your nice introduction is again making me a bit conscious, but
आप उसके काबिल हैं.
Thank you so much, sir. So first of all, on the onset, I would like to extend my sincere thanks to CLCGC team and especially Sanjeev sir and other members for providing me this platform to express my views. And my job has become more difficult and tough because it's Monday morning first. Second is it's the last session, and the third, my previous speakers have already raised the bar by their knowledgeable session. So, but I promise to keep that pace up and be as energetic as Sanjeev sir is and Amit is also. So let me share my screen first. Am I audible?
Yes, you are audible. Yes, you are audible. You are audible. You are audible.
Yeah.
Go ahead, please. Go ahead, please.
Yeah. Can you see my screen?
No, we can see you only. We can't see your screen. Maybe you need to upload.
I did it.
Share your screen. There's a third icon next to the mic speaker. Share the screen.
Somehow struck.
नहीं होता है कई बार. Don't worry. आराम से कीजिए. होता है. It happens sometime. The third icon you need to share the screen.
My entire screen is frozen.
You log in again. You log in again. You go out and log in again.
Okay. I'll just do that.
So, Chiriniwas, you are a techno savvy also, right?
No. I'm the senior most council member.
I know, sir. Sarika ji, now it's there. देखिए.
You can see my screen?
Yeah,
Yes.
it's there.
Yoshiji, आपके साथ तो चल गया.
अरे चलो.
Okay, so to start with, I would like to make a few mention here that this Caro 2020 is and would definitely make the life of companies as well as auditors slightly more difficult. But if companies prepare well within time and also auditors train our staff and etc., we can very well achieve the objective of MCA and ICAI together. So the responsibility which has been given to me today is for leftover clauses, which are from 11th to 21, and mostly the clauses are modified or new herein. So let's get started. So here in my kitty today is we have fraud related clause and whistleblower related clause, which we will be discussing. Then we have compliances by Nidhi, then transactions with related parties, then internal audit system, then non-cash dealings with the directors, registration requirements under 45IA of RBI Act, then cash losses, we will be discussing that in detail. Resignation by statutory auditors, we will also focus on this clause. And material uncertainty on meeting liabilities, it's very, very critical clause which has been introduced, and we will spend some time on it as well. Transfer to fund specified under Schedule 7 to the Companies Act, which is again a new clause, and definitely we have to put some energy on this clause as well. Last but not the least for today is the qualification or adverse auditor's remark in the other group companies, which is a new clause, and that is the only clause which is applicable for consolidated financial statements. So we will also like to spend some time on it. So the first clause comes, which is very, very subjective, is fraud and whistleblower complaints. So the presentation, how I've structured today is, I have, since it's a mix of audience, so I have put in the requirements for both the companies as well as the auditor. So whatever we as auditors have to ensure, it is the company at the first place, they have to maintain those records or those compliances in place first. So it is for the companies first to have that readiness in place, then only the auditors will have to have, ensure that compliances. So coming to this clause, so if you could see in the red, it is a modified clause. So what has changed really? So if I talk about fraud by the company, nothing has changed. But with respect to fraud on the company, the word officer and employee has been removed. Therefore, the scope for reporting has been widened. The inquiry per se for this clause is restricted only to frauds which are noticed or reported during the year. Then as an auditor, we have to comply with the requirement of SA 420 and Section 143.12, which is fraud reporting to the central government. Then management to provide for our effective reporting for this purpose is the internal audit report, the minutes of the board meeting and audit committee meetings, and of course some written representation that the management has assumed the responsibility regarding the internal control system, effects of uncorrected misstatement, and they have provided the complete disclosure. The next comes in the row. We can also discuss anything regarding the fraud inquiry with the employees and officers to make this reporting effective. Then if there is an unaccounted income, as we just heard a few minutes before, that can also be an indicator of misstatement regarding fraud, and we cannot miss our attention on that clause. We have to relate it, we have to link it. Consider the principle of materiality. So the entire concept of CARO and any other reporting of ours as an auditor revolves around materiality, so as this clause is. Now coming to the next clause, which is again a new clause within the same clause, is we have to report the reporting which has been done by us as an auditor to the central government under Section 143.12, and this reporting can be done and can be considered, and has to be considered rather, up to the date of issuance of our auditor's report. So even if we did it post year end, we have to report it here. This reporting is also applicable if any of the frauds are reported by any predecessor auditor too. Also, if similar kind of reporting has been done by the cost auditor or secretarial auditor, the reporting has to be done under this clause. My apologies for going a little faster, but we have to put in everything within the time frame provided to us. This is a new clause again. This is a sub clause. This is consideration of whistleblower complaints received during the year. Not every company is required to have the whistleblower mechanism in place, and so there may be a statutory mandate for the companies to maintain it and may not be. So in that case, the reporting requirements and the way we have to word our reporting in the auditor's report will be slightly different, as has been guided by the ICAI through the guidance note. So no reporting has to be...
Sarika, I would request you to maintain your own pace. If 5-10 minutes extra need to be given, we can do that. So there is no need to rush.
Sure, sir. So, sure, sir. I thought sir will come and say this is your last minute, so I thought I should keep my own pace. No, thank you so much, sir, for allowing me the extra time. Thank you so much. So we have to see if the company is under the visual mechanism requirement as per Section 177 of the Companies Act, and if it's a listed company, they have to also comply with the listing requirement. Further, if the mechanism, as I just mentioned, it's been mandated by law, the company has to have the set process in place and set process for receiving and investigating and most importantly, resolving those complaints in the appropriate and timely manner. If the mechanism is established on a voluntary basis, then obviously, if the company is claiming that we have established the system on a voluntary basis at our own, then they have to still define that process and they have to meet those processes as well. For the companies where though no mechanism is mandated or the company is not having anything on a set basis, on a voluntary basis, and in case they receive any complaints, still they have to resolve it in an appropriate manner. For this purpose, for our reporting purposes, management has to share the minutes of the audit committee and board meeting or any complaints what they have received during the year. We need not to see anything for earlier years, as I mentioned in the beginning of my slide. For any complaints what we receive as a whistleblower complaint, we have to also link it with the possibility of the fraud. It's not the case every time, but we cannot deny the fact that it can also entail or it can also link it to the fraud possibility within the organization. A written representation again is a must from the board or the audit committee, ensuring the completeness of the process and the complaints, and obviously the evaluation of the complaint received and resolved. So I'm done with the section 1, which was clause 11, that was on fraud and whistleblower policy. Now coming to Nidhi, that is next clause, which is clause number 12. Again, if you could see on the top, it has been modified. How it has been modified? The first 2 sub-bullets were part of first one part only, one requirement. It has been broken down into 2 sub-bullets. One more requirement, which is default in the payment of interest on deposits or repayment thereof, it has been added now. So the first parts ask us to ensure whether there is a compliance on the part of the Nidhi companies regarding net owned funds to deposit, which has to be in the ratio of 1:2 to meet their liability. This is the previous clause, but as I said, it has been broken into 2 parts. The second sub part of the previous clause is maintenance of 10% of unencumbered terms deposit to meet the liability. So these are not new requirement, but we will touch base a few critical aspects which anyways companies are required to have and auditors are required to ensure. Management, first of all, need to provide us the computation of deposit liability as well as the net owned fund. Secondly, there is a form which has been filed by these Nidhi companies, which is NTH3. It has all the details regarding deposits, details of loan, financial summary, and number of deposits accepting banks. So the banks who are accepting these deposits, the numbers have to be quoted. That's what management will provide us for our verification to do about this clause. Obviously, the main thing comes here is schedule of payment of interest and payment of deposit. That is for the new clause which has been added. So this is the basic thing what has to be provided and has to be maintained at the first place by the management of Nidhi companies. Then this is a suggested reporting by the guidance note of ICAI, where if we find any default regarding these clauses, we have to specify the nature of the default, amount of the default, period of default, and number of persons to whom there are default, and any other remarks which we may want to give. Maybe if some company has made the default good post year end, but the default was continuing during the year, and if we want to make that positive remark in this reporting, we are free to do it. The most important point what I want to bring here is, as and when we see some suggested reporting by ICAI or any of the guidance notes or any technical guide issued by ICAI, it's a breather for both companies as well as auditors, because we should be cognizant of that fact if something is coming from the accounting regulator, though it is in the suggesting format, but it gives us a breather that this is something at least we should include it. So these are some of the aspects which we should take care of even for the companies and for the auditors as well. So these many information should appear in our reports. Now coming to the next section after Nidhi company is compliance on transactions with the related parties. So what has happened to this clause? There has been no change, but in its nature, this clause, these sections per se are really important. So I would like to spend a few seconds here. Still, there are no changes. How? For proving the compliance regarding this section or this clause, management has to provide us a written representation regarding the identity of the related parties and related party transactions, their accounting and disclosures, and also they have to affirm and have to confirm us that there are no undisclosed side agreements. So these are list of bare minimum documentation requirements what companies need to ensure. So this is not a complete list, I must say, but this is something companies must have to start with, and the auditors should at least vouch for reporting in this. Obviously, there will be additional requirement for the companies as well as for the auditors to ensure. So the companies have to assure us that there are no undisclosed side agreements with the related party which could impact the related party transactions. And most importantly, they have to assure us that there is a completeness of the information what is being put forward to us. Needless to say, minutes of the meetings of audit committee and board of directors is something they need to provide us, and we need to assure that what are the nature of the related party transactions. List of parties in the register maintained under Section 189 is the base for us for the Companies Act compliances to start with, and also the declaration of interest made by the directors in the form MBP1. So I would like to split this clause in two parts because we have to assure the compliance regarding Companies Act as well as applicable accounting standards. So the related party definition and those entities might be different. So we have to be very, very cautious what we are reporting, how we are reporting, and what is the basic requirement of the underlying rule. Now, we have to also assure as an auditor the compliance of SA 550, which is regarding the related party transactions, to ensure that related party transactions which are outside the normal course of business, and if there is a transaction, how to report it, the related party transaction, if they are at arm's length or not, and how the appropriate accounting and disclosures of these related parties are done as per the applicable accounting standards. Now coming to the fourth section, which is internal audit system as per clause 14 of CARO 2020. What is new about this clause? Though the law already mandates, this section 138 of the Companies Act already mandates certain classes of companies to have the internal auditor and therefore the internal audit system in place, but the reiteration of that fact and confirmation of the fact has been brought in the CARO, and wherein we will also patch in the system and ensure whether the internal audit system is effective and running smoothly as far as the size and the nature of the company goes. And that is how Ministry wants the confirmation from our side as well, whether the internal audit system, which is the basic skeleton of any organization to start with, is correct or not. So there may be certain classes of companies who are required to have internal auditor as per section 138 or not, but this clause or the guidance note of ICAI also suggests to report for those companies also, but it's a statement of fact. If a company is not required to have the internal auditor in place, but if the company has it, then we have to report it. If the company doesn't have it, we have to put that forward in the report, giving the statement of fact. The points for us as an auditor and for the companies to provide us are the existence and functionality of the internal audit system. There has to be this internal audit system in place for companies. The size of the internal audit department, is it commensurating with the company's size, the nature of the transactions, the complexity involved, etc. What is the qualification and the responsibility of the internal auditor? What is its scope, whether it has been decided as per the norms of the company? What is the periodicity of the reporting, whether it is appropriate or not? And most importantly, compliance with SA 610 for us to ensure. What are the remedial action, whether the management is taking the periodic remedial action on the internal audit findings, because internal audit is an ongoing process. So management cannot take the remedial action at the end itself. It has to be periodic. Efficiency of the internal audit system by reviewing the minutes of the meeting. Are those documented well? Are those the critical areas are reported, whether the management is taking the remedial action, what is the frequency of repeating the same type of errors in the internal control systems or otherwise. So by reviewing the minutes of the meeting, it gives us a flavor how effective that internal audit system is. What is the impact of control deficiencies while framing report on ICOFR with reference to financial statements? So we have to also take into consideration what are the control deficiencies, whether those control deficiencies are factored in while we are framing our report on ICOFR. We have to also assume and need to see the compliance regarding the SEBI LODR regulation if it's a listed company. Now moving to the next section, which is non-cash dealing with the directors. This is again not a new clause, but this is again a very sensitive clause or a very complex clause, and there is no complete list for any company to show to us that this is the list you show, there are no transaction, or if there are transactions, we have done it in a proper manner. There is no complete listing. There is no comprehensive platform wherein they can showcase and we can ensure that this is a complete and correct reporting under this clause. We have to have that skeptical mind to question, to ensure the compliance under this section 192. But to start with, to have that guidance in place, the guidance note suggests some of the key items which we as auditors should ensure and the companies should have those in place. So what are those? First of all, management need to provide us a written representation, obviously at the last, but this is a primary requirement or requisite, I can say, that the company has complied with the requirement of section 192 of Companies Act, where there are non-cash transactions with the directors or any other persons connected with the director. So that has to be approved, and there has to be the valuation done by the registered valuer. We will just understand that requirement at the last of this slide. So we have to get that representation from them, because the assurance first comes from management and then we will verify it. The second the most important point here is if the director or any connected person with the director is also the director of the holding company, the similar compliance has to be ensured by the holding company with regards to this reporting. For that purpose, we have to have the written representation from the holding company as well, that they have done that compliance. Further, for the verification, so as I said, at least it's a breather that we have something in place to start with, and then we can link up these transactions with the other things. So to start with, we should have MBP 1, MBP 2, 4, which are interest, disclosure of interest or notice of interest by the directors. Registers of loans, guarantees, where we can see if there is a guarantee, it's not the on paper or it's not a monetary thing. We can gauge if there is a guarantee which has been provided on behalf of the director or any person connected to him, or any register of the contract or with the related party, etc. will at least highlight or flag that thing, that there may be a possibility of non-cash transactions with those people. The movement in the PP register is again something where we can see if that particular register has some item which is not used by the company, it might be used by the director. So in whose name it was purchased, who is using it. So that can raise the flag that there is a non-cash transaction and there is a possibility thereof. Minutes of the meeting wherein there may be approval of certain items to be given as either free of cost or some for some value which are not involving immediate monetary value will give us some flavor. Reports which may be available in that value has to be determined by the registered valuer. This is the mandate as per section 192 of the Companies Act. The most important aspect under this clause, though it's not a new clause, but the term person connected with the director as quoted in this clause has not been defined under the Act. So we can draw inference from the other section or clause wherein we have the people enlisted under the term any person in whom the director of the companies are interested. So at times we are struck that how to find person connected. It can open the Pandora box, but if we get a guidance from the guidance note, we are at least have that breather again, that yes, this has been given in the guidance note. Yes, we can follow this at least to start with. Moving to the next section, which is regarding registration under 45IA of RBI Act. This is clause number 16. Here what has changed? So as regards IA, the first subclause A is concerned, there is no change, but still a few key take home for us. We have to ensure if the company is engaged in the business which might attract this registration as per the RBI Act. Management also need to provide us the written representation if in case, because this is something we cannot assume by ourselves. So this representation has to be taken from them that this certificate of registration what they obtained is not been withdrawn or is not in place, and more so in those cases if it has been withdrawn and they are still continuing with that business. The next subclause which has been added here, which is a new clause as I said, because it has been added, that though if you see the requirement of the first clause and second clause somehow are same or interlinked. If the company is conducting any NBFC or housing finance activities without valid CUR, because that registration part we have already covered here. So that is somehow linked with this. So again, we have to verify whether the company is doing some business where there is a need to have a certificate of registration, being an NBFC or housing finance company. And similarly, if the written representation we have to have from the management in case the certificate has been surrendered and they are still continuing with the business, because this is something which we have to have the confirmation from the management unless that is available in the public domain. The next sub clause within this clause, which is again a new clause, is that is regarding core investment companies, which are in short called as CIC, which is again defined by RBI. So there may be two things. First of all, if it is a CIC or if it is exempted, and whether that exemption continues. So it may so happen in the first year of reporting, the company fell within that category where that exemption to get registered as CIC was available, but in the next year, that exemption criteria is changed or the company falls above that criteria. So this evaluation should not be as such continued from the previous year. It has to be done on year basis, whether the company is still CIC or whether it is still exempted from that criteria. That has to be done cautiously every year. So again, a similar requirement that we have to see the directions if they are required to obtain the certificate of registration, and in case if it is exempted earlier, whether that exemption continues or not. That's what I just mentioned. The next clause, which is again a sub clause of this clause itself, which is a new clause, wherein we have to indicate the number of CICs within the group where it has more than one CIC as a part of it. So they want to see if there are more than CIC. So this is simple, straightforward statement of fact wherein we have to report number of CICs. Further, very good point as per the guidance note which I could locate was, we have to ensure that on the RBI website there are certain database of registered CIC which is available. So if the company is providing us, we can have that, we can corroborate that information from that listing from CIC of listed CICs on the RBI website. One more important aspect regarding this, because it's a new clause and we will brainstorm going forward as and when things evolve. But since these two things are given to us and mandated to us by our accounting regulator, so we have to make sure if any of the non-compliances which we see as far as this clause, it should reflect in the NBFC's auditor's report, which we normally do as per these directions. So there has to be a cross-linking between the two. So if we report something negatively here, it cannot be unaddressed in the second report. It has to be taken forward to that report as well. Now coming to the next clause, which is cash losses, clause 17, I can say. This is a new requirement. It used to be earlier, in the earlier versions of CARO, but it has been brought in again in the backdrop of current pandemic or other economic changes or other things known to us. So we have to report the cash losses incurred by the company in the financial year, current financial year, and in the immediate preceding financial year. The most important part here I would like to quote is cash losses is not being defined. So what do you call it as cash loss? Is not been as such defined in certain periphery by neither the Companies Act nor any applicable accounting framework. We have to derive this value. How to derive that value? We have to go with the profit and loss of the company, be it as per AS or Ind AS. For Ind AS, we have to take care of OCI, etc. So that's a little complicated. So we have to take care which framework the company falls within, and accordingly we have to make the adjustments for non-cash transactions. Also, we do not have to make any adjustments which for the expenses which are contingent in nature. Very important important point I would like to quote here, do not start with cash flows which are as per the operating activities, because apart from non-cash items, for non-operating items, you might have to do certain adjustments. So it's better you start with net profit or loss after the tax and do adjustments for non-cash items. This is again, I would like to bring your notice or attention here. For cash losses, if there are certain qualifications which lead to any non-cash adjustments, you have to make it. So please make sure for current year as well as the previous year, you make the adjustments, and if that is not quantifiable, you will disclose that fact. So that was very, very important aspect which I'm telling you. Please bear that in mind, because that is a very subjective clause again, and we can commit some mistakes if we leave some items, so we may be at the borderline or we may end up doing wrong reporting. So please be cautious of these facts, at least, if not more. This is again very, very important clause which has been brought in again.
Can you hurry up, please, Sarika, please?
Sure, sir, sure, sir. I'll take 2-3 more minutes, sir. Is it fine?
Yeah, please.
Okay. So with regards to resignation of a statutory auditor, which is clause 18, this is a new clause, and we have to assure certain things that it is not applicable in case of rotation of auditor. It is only applicable in case of casual vacancy. And as an auditor, I have to ensure every guidance which has been issued by ICAI, be it Code of Ethics or Guidance Note or Companies Act, and for listed company, there is a specific circular that has to be ensured by the incoming auditor. The management needs to provide certain things for the outgoing auditor, which is resignation. It will clearly bring out the causes of resignation along with ADT3 and Annexure A, which is a new thing wherein the listed company asks the outgoing auditor to provide certain details. Minutes of the board meeting to gauge the reasons of resignation, communication with audit committee, and the previous reports which have been issued by the auditor can also highlight some of the causes of its resignation. If it's a joint auditor case, if one of the auditor is going, the first auditor needs to take care of the reason for the other auditor as well. Material uncertainty, it's very, very important, and I would like to spend a few seconds out here, because there are a few indicators or requirements as per the clause which have been mentioned, that basis this or any other information, if you as an auditor believe that there is a material uncertainty that the company would not be able to meet these liabilities in a period of 1 year's time, then you have to highlight, you have to raise that flag, and you have to link this situation with the going concern reporting what you are making in the financial statement. So these two reportings will go hands on hand. You cannot have one kind of reporting in going concern and the other kind of reporting here. So those two have to be in sync. So you have to take care of everything regarding going concern, viability, documentation, what has been provided by the management to you, and managements have to provide these many information, which is board meetings and detail of commitment, repayment schedule, and their expected cash flow, etc. If there is a support letter from the parent company, you have to assure the financial viability of the holding company as well. In case of NBFC and the other kind of similar companies, their reporting, their specific reporting made to RBI needs to be ensured, and management need to provide certain representation to assure the viability of the company as a going concern and to meet the liability in near future. Further, this is a very important point. You don't have to draw the relationship between the unpaid liability and the asset, the corresponding asset, on one-to-one basis. You can do that assessment on the overall basis. This is again, I think Sanjeev sir had already highlighted some points here.
Yeah.
So quickly, we have to assure that either the company, if they have ongoing project or not ongoing project, in either of the cases, we have to assure the compliance of section 135, whether the company has transferred the amount in the specified time, whether it's 6 months in case of non-ongoing project or 30 days time in the bank account, or 3 years time. Everything, whatever is mandated by section 135, we have to assure. And one more point I would like to bring here, as sir said, that it's no more provide or disclose provision. If there are penalties, prosecutions for companies, we will equally be liable if we do not report that correctly. So similar case is for the second part, where it does not relate to ongoing aspects. So almost similar compliances.
We are running out of time.
Yes, sir. So is the last clause, just one, last 30 seconds, sir. So if there is a qualification or adverse remark in the CARO, we have to report. And here, one and only important point I would like to refer. Your qualification does not mean you go for SF 705 or 706. This is qualification remarks which are given in the para 4 of the CARO. That's what we have to just take care. That's it from my side, sir.
Thank you, Sarika. Thank you so much, sir. And I must say that kudos to the CL and CGS team, ICAI, and all three faculties who have spared the time and devoted. The clause by clause is actually done very closely. The clause by clause is done so closely that we got
request Sarika, can we request Sarika to take off the presentation
Sarika,
from the
can
screen?
you take your presentation, please?
Speakers are visible.
So it's a wonderful presentation by all three the faculty members, and on behalf of participants, I take liberty to thank you all so much.
Jagnesh bhai, I must also thank you. You are, if Yoshiji is in 40th year of profession, you are in the 39th year of profession. Yeah. And you have not only been our student in the IFRS certificate course, but as a faculty, you have contributed outstandingly, and not only in Mumbai, but in all parts of India, wherever we have given you the responsibility. And now you are an integral part you've been a part of the India's implementation committee, a part of the accounting standard board, and you have contributed so significantly. Even for our international program, you are the preferred choice of Master of Ceremony. And for the next program on 16th of April also, you have kindly agreed to be the Master of Ceremony. So thank you so much for your contribution to ICAI.
Thanks to the participants a lot. And now we have very little time. Sanjeevji, one question is there for you. And agar aapki ijazat ho, if you permit, then I'll take this question to you, sir.
Please, Ignish. Okay. We can spend 5-10 minutes on the question. Fine. At least one question you can ask to all the speakers.
There is no question for Sarika, but there is one question for Amitji. Okay. Inventories given by the company to bank or financial institution should be paid inventories or not? I repeat, inventories given by the company to the bank or
financial statements are prepared on accrual basis. Payment, if that way you see, even for the receivable. Payment is certainly not mandatory. Otherwise, there will be no trade payable and trade receivable. So it's on the accrual principle. So whether it's inventories, whether it is debtor, payment is not important. If it is due, then yes, it is to be included in the assets as well as in the liability.
Sanjeev sir, question is different. Question is of paid inventory given to the bank. That means there is no double financing. See, you are my supplier. I took 100 rupee inventory from you and I gave it to bank without paying you. Means you are given me credit of 100. Bank is giving me another credit of 75 on the same inventory. It's a double financing. The question asked by the questionnaire is that whether when you are giving inventory to the why this question has come, because SBI is not asking for creditor. It was not asking. Today it is asking for creditors to calculate DP. If the DP calculation requires creditors, why it requires creditors is only paid inventory can be financed by bank. If you are not paid for inventory, you already got a credit against that. It cannot be financed. So here the question is whether paid inventory only should be reported or not. Yes, only unless the bank sanction letter does not require you to give creditor has to be given to calculate DP, and it is a part of the statement given to the bank as far as the stock and debtor statement is concerned. It's a part of that statement. If the bank itself says I don't want, then it's a different thing. because SBI has argued differently. I'm not taking your time why SBI did not want it and what is the rationale behind it. But now SBI has also started asking for it after AASB objected to that DP cannot be calculated without creditors because it is a paid inventory that can only be financed. Otherwise, there will be a double financing. Is the question, sir? I think the question.
That's very interesting, Yoshiji. You added the bank audit dimension to it. I always believe that that when bank computes the GP, it takes into account the assets
paid inventory,
as well as the
paid inventory only. Yes, sir. So, sir, the question is from that side whether that auditor who is a bank auditor is asking, I know what is a paid inventory. When the party has not given paid inventory and got double financing, whether I should state it or not. Let Amit answer as an auditor, like whether he will qualify this report or not qualify when paid inventory is not reported, but unpaid inventory also is reported to bank. Whether that is right on part of the borrower.
Yes, so Yoshiji, I think the answer is again the one answer we can give at least at this forum is that because the first thing is we have to look at the sanction letter. So what the bank requirement is, I think that is what we should do. Maybe for the participant in this call, saying if the bank requires in a particular manner, we will not go outside the bank because otherwise we get into forensic mindset. But we want to go that path.
That's right. Okay. Next question. There's
a question for you that is there some variation allowed in the actual stock inventory and the one which has been reported to the bank? Is some variation allowed, permitted?
No, so I think the point is that the variation will be reported by the auditors. So the requirement under the clause is it's then only to the bank to decide what actions they will take. But the law says that if there is any discrepancy, you please bring it out in the report. So now in a company, you can imagine that is the consequence. So I think the whole objective of this webcast was
to say there is no threshold limit.
No threshold limit at all. So I think, of course, there is an overall materiality which works in anything on the accounting side and auditing side. But I think what we personally believe in items like this, like statutory dues and some of these, the idea would be unless it is absolutely immaterial, I'm not thinking, but most likely you will bring out the discrepancy. If there is a discrepancy, ideally there is right now from a guidance perspective nothing saying that okay you look at the materiality, because then it becomes very judgmental how much one person will take versus another. And the idea
so what I take from you is that there is no threshold limit, there is no numerical threshold limit laid by the company.
Yagnesh bhai, I think we need to go to the text of the CARO. I think there the word material is there. We can just check that, but materiality, as Amit rightly said, materiality is fundamental to the entire process of accounting and auditing.
So Sanjeev says that this has been whether the quarterly statement filed by the company with the banks are in agreement with the books of account, if not give details. So they have just left it there. So there is no materiality on this.
Sanjeevji, Amit is right that some of the question would go on facts of the case. Materiality, which are where there is an opinion, where there are both the parts in CARO, wherever opinion is to be given and fact is to be stated. When opinion is to be given, materiality will apply. When fact is to be given, no materiality will apply. But I'll give a rejoinder to this as an auditor in bank, that here we have to go by books of account. In physical terms, in jewelers, the inventory is higher in physical terms. But in the books, the inventory is less. I have to report what is in the books with the statement given to bank, not physical with statement given to bank. I am not elaborating here. You just think over it, the listeners, what is the difference between the book inventory versus given to bank and actual inventory, which is higher or lower as compared to that given to the bank. And there are issues in this. I will not elaborate, but you have to go by the books. The question is on books of account and not on physical value of the inventory, and that will change completely the answers, or if you go by physical inventory valuation that is right or not right. I think Amit will agree with me.
Yeah, that's right. And I think the important thing is we just stick ourselves to say the whole moral check of this exercise is to say what company is reporting, there is somebody who's independently verifying. That's the role of the stat auditor. They are just putting that check rather than saying, what is there, should be the right number, how much is discarded, how much is this. If you report something, can you please tell him, Mr. Auditor, whether this number is coming from the books or not? That's what the bank is asking for. That's limited.
Yes. Thank you.
All right, Sanjeevji, there's one question for you. This is concerning for the unpaid dues. Won't we have provisions question. Number 2 part. What if the monthly stock statement audit trail will not be applicable here, but main question is about the unbilled dues. For unbilled dues, won't we have the provisions? This is the question.
The first, these unbilled dues will be the ones for which the invoice has not been received by the organization, but a liability would have been created. So certainly, because if liability has also not been created, then from where in the world the auditor will get to know. So obviously, when the ownership has been transferred, so whether it is FOB or it is CIF, based on that, liability has been booked, but his bill is yet to be received. So this is what is intended.
Provision has to be created, Vaji.
Yeah, absolutely. It's a accrual basis of accounting.
True.
And I'm happy to say that I think now more than 600 people are there on.
618 people, 627 rather, sir. 627. 627 was the last highest I noted, sir. Great number, sir. Great number. Now 653, sir.
Very good.
653 numbers. 650 numbers. So participants, great kudos to you. आपके लिए बधाई हो, तालियां हो जाए. Sunday को, even on Sunday, you managed to spare time and be with us. Thank you so much. Sanjeev ji, jate, very small question. Is there any exemption for the small companies for the Schedule 3 requirement?
All exemptions we are giving for non-corporate entities now. Yagnesh bhai, for non-corporate entities, we have brought 4 levels of accounting standard. If it's a company, only accounting standard exemptions are there. Some exemption as in the SMC. We have requested MCA even to revise that criteria. Apart from that, there are a lot of exemption for the small company. Beyond that, ministry is not saying any exemptions.
Chairman sir, thanks a lot for sparing time and be with. You had mentioned to me that you will be there only for half an hour. But the speakers made so interesting that you had to be glued to the program and be with us. Ant tak hamare saath rahe. So sweet.
Yes, sir. Yes, sir. Thank you very much.
Thanks so much. Leader hoga aise.
Sir, I have something, personal interest, because I am a convener of the group on Schedule 3 and I wanted to listen to Sanjuji. So I said half an hour because he was supposed to speak half an hour. But then I am also speaking on Caro at various places this year. So other 2 speakers also made a lot of sense at personal level. And they have done a beautiful, beautiful presentation and very detailed guidance to us. Thanks a lot. Thank you, all of you.
Thank you, Amit. Thank you, Sarika. Thank you.
Sanjeev, thanks a lot. Amit ji and Sarika. And I must acknowledge the support of the back team like Rangoli Sharma and Sarika Singhal and all the staff of the ICAI who has made this webinar possible.
And of course, thanks to the president and the vice president, who gives all the possible flexibility in organizing these programs.
Thank you. Thank you, sir. Thank you all. Thank you all.
Faculties is going to the house of the participants.
It's okay. Thank you.
That's the endeavor and the initiative taken by the torchbearers of ICAI, president, vice president, and everyone. Thank you so much, sir.
Thank
God
you.
bless you.
Thank you. Thank you. Thank you. Thanks all. Thanks all. Yeah.
Everybody. Bye.
Thank you, sir.